Federal government's failure to protect the average homebuyer amidst the housing market pricing crisis. Now, Canadian mortgages get new guidelines after mass risks materialize. The Canadian housing market has experienced unprecedented growth in recent years, accompanied by soaring prices that have left many aspiring young homebuyers struggling to enter the market. This situation has been exacerbated by the influence of investors and speculators who outbid these potential buyers, fueled by access to greater resources and borrowing power. While the federal government has recently taken steps to provide guidelines for handling the financial struggles of these investors and speculators, it has failed to address the concerns of average homebuyers who were left on the sidelines during the housing market frenzy. Here we will delve into the federal government's inaction and highlight the consequences of allowing the housing market to spiral out of control. A lack of government intervention. Over the past few years, numerous news articles have sounded the alarm bells regarding the unregulated growth of Canada's housing market and the subsequent difficulties faced by young Canadians seeking to purchase a home. Reports have highlighted how investors and speculators were outbidding average homebuyers, driving up prices and creating a housing affordability crisis. However, despite these warning signs, the federal government failed to enact laws or guidelines to protect the average homebuyer from being overshadowed by deep-pocketed investors. While some argue in favor of a free market approach and limited government intervention, the consequences of this laissez-faire approach have become glaringly apparent. Instead of implementing measures to cool the overheated market and provide relief to struggling homebuyers, the government's inaction allowed the gap between housing prices and purchasing power to widen, further disadvantaging the average Canadian. Consequences of neglecting average homebuyers. The federal government's failure to address the housing market crisis has had severe consequences for the average homebuyer. As investors and speculators obtained properties at inflated prices, aspiring homeowners found themselves priced out of the market, unable to compete with investors' financial resources and borrowing capabilities. The dream of homeownership, once an attainable goal for many, became increasingly elusive. This lack of action not only perpetuated wealth inequality but also hindered the social and economic mobility of young Canadians. Homeownership has long been seen as a pathway to financial stability, wealth accumulation, and community roots. By not intervening, the government has undermined the aspirations and future prospects of countless individuals and families. Government priorities questioned. The recent move by the federal government to provide guidelines for financial institutions regarding struggling investors and speculators raises questions about its priorities. While it is essential to mitigate the potential fallout from a collapsing housing market, the government's swift action in this regard contrasts starkly with its prior indifference towards the average homebuyer. Critics argue that the government's intervention in protecting investors and speculators demonstrates a misplaced focus on safeguarding those who participated in the speculative frenzy while neglecting the needs and concerns of ordinary Canadians. This asymmetrical response has further eroded public trust in the government's ability to address housing affordability issues and support the aspirations of young homebuyers. It's obvious that the federal government's failure to enact laws or guidelines to protect the average homebuyer during the housing market crisis has had far-reaching implications. By allowing investors and speculators to dominate the market, it effectively shut out aspiring homeowners with limited resources and borrowing power. The consequences of this negligence have created a substantial wealth divide and hindered social and economic mobility. Moving forward, it is imperative that the government takes decisive action to address the housing affordability crisis and prioritize the needs of the average homebuyer. The development of comprehensive policies, such as affordable housing initiatives, stricter regulations on speculative investments, and support for first-time homebuyers, is crucial to ensuring a fair and equitable housing market that benefits all Canadians. Only through proactive measures can the government begin to rectify the failures of the past and restore faith in the housing market as a pathway to homeownership and prosperity for all. Recently, the federal government has stepped in to propose guidelines for banks in dealing with mortgage borrowers that are facing financial difficulties or defaults. The government seems to be stepping in just as investors are likely to experience losses and financial difficulties. The article below from Better Dwelling on July 10, 2023 is very skeptical about the reason that the federal government is stepping in to help protect consumers, the average homebuyer, as opposed to the investors and speculators. Why did the government not step in before to help the average homebuyer who was forced to participate in an outrageous bidding process when buying a home? A process that the average homebuyer often could not win. It's obvious that the federal government is worried about the investors and speculators losing a substantial amount of their investment dollars and is now trying to act to protect these investors and speculators under the guise of mortgage guidelines to protect home mortgage borrowers. Canadian mortgages get new guidelines after mass risks materialize. In an article titled "Canadian Mortgages Get New Guidelines After Mass Risks Materialize" by Better Dwelling on July 10, 2023. The author points out that the Canadian real estate markets have been ranking high on global bubble lists. Yet speculators continue to invest. To understand why, one can look at the recent guidelines released by the Financial Consumer Agency of Canada, FCAC, the government watchdog for consumers. The guideline, known as the Guideline on Existing Consumer Mortgage Loans in Exceptional Circumstances, outlines expectations for lenders, urging federally regulated financial institutions, FRFs, to go to great lengths to assist borrowers in over their heads in debt. The article underlines that Canada currently harbors the most indebted households among G7 countries despite warnings from international agencies. In response, several solutions were devised to facilitate easier access to credit. One such solution was the adoption of adjustable-rate mortgages with fixed payments. These mortgages, which were not particularly popular prior to 2020, saw a surge in popularity among investors. As interest rates began to normalize, less and less of the principal amount was being covered, resulting in negative amortization. Shockingly, approximately 25% of mortgages in Canada now fall into this category, with some not expected to be paid back for over 70 years, despite the maximum mortgage term being 35 years. Surprisingly, instead of cracking down on these risky lending practices, regulators are endorsing them and even ordering further accommodations for over-leveraged borrowers. The FCAC expects FRFIs to establish procedures for identifying at-risk mortgage borrowers and making accommodations such as waiving prepayment penalties, internal fees and costs, and even extending amortization periods. However, the article suggests that these measures may create more risk than they mitigate. The author points out that regulators seem to be primarily focused on protecting investors rather than the average consumer. They note that only a third of households have mortgages, and a lesser portion of those have variable rates. Moreover, the concentration of risk lies with recent purchasers who carry excessive debt. This contradicts the assumption that these guidelines are primarily meant to assist first-time buyers. The article further highlights the position taken by Canada's state-owned mortgage insurance company, which refuses to honor insurance on extended amortizations. The article raises concerns regarding the long-term consequences of these guidelines, including higher home prices and increased risks within the financial system. Regulators, pressed by policymakers, have acknowledged that extended amortizations contribute to bolstering home prices. By spreading payments over longer terms, the credit capacity of homebuyers increases, enabling sellers to demand higher prices. This neutralizes the impact of higher interest rates, making it seem as if they are not as impactful. As a result, higher interest rates may be necessary to balance the market. By extending amortization periods, costs remain lower, benefiting investors and increasing their profits. However, this also reduces the housing supply, as it favors over-leveraged investors, who now have a seemingly attractive investment opportunity thanks to the federal government's intervention. The concept of moral hazard is raised, as it appears that over-leveraged individuals receive special treatment, lower costs, and longer repayment terms, while responsible borrowers are left without such benefits. Overall, the article is warning that the newly introduced mortgage guidelines, along with regulators' focus on protecting investors instead of consumers, further perpetuate the government's failure to address the challenges faced by average homebuyers during the housing market crisis. The article emphasizes the potential risks associated with extended amortizations and highlights the concerns raised by experts regarding household debt and the increased risk of a financial crisis. Please let me know what you think in the comments. Did the federal government do enough to control raging housing prices before, during, and soon after the pandemic? Now that investors and speculators may face declining prices and mortgage defaults, is it appropriate for the federal government to step in and bail out the same investors and speculators that caused most of the uncontrolled housing price increases? Is the average home buyer well served by the federal government's attempts to prop up housing prices with these guideline or further bailout measures? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.